Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitri Pagamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Let me share my screen here. If you guys are joining us for the first time, the reason we do this show is really to answer questions you may have about Market Chameleon tools, data analytics. If you wanted to discuss strategies or come on a show and talk about something unusual you've seen, we welcome that. There are two ways to ask questions. One is to put that question, type it in the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. When you click on it, it takes you over to Zoom. There's a button on the bottom of the screen, raise your hand. Click on that. When you click on it, it'll prompt you to turn on your camera. You don't have to turn on your camera. Once we let you in, everybody could hear you and you could ask your question live and direct. While we're waiting for questions to come in, what I'm going to do is quickly take a look at the pre-market report, see what's trading, what's happening in pre-market hours. I have been getting some questions over the email, over the weekend, yesterday. I could default to those questions as well. And I do want to talk a little bit about some of the new features we've been pushing out yesterday, over the weekend. Some you may have noticed, some you may have not noticed yet. I'm going to go over them quickly as well, show you what they are, how you could potentially use them, and it's setting up for some bigger features that we'll be releasing later on. So I'll talk about that. And well, if you have questions, let me know. I'll try to answer those first.
Perfect. And Alex Abba just showed up and asked if there was a show yesterday, and unfortunately not. D and I had personal things we had to take care of and business things that led us to have to cancel the show, unfortunately. But we try to do it every trading day.
Yep. Yesterday we had to cancel it. But yeah, we try to do it every day. Sometimes we get into situations we can't do it in the early morning. So let's start out with the pre-market report, take a look at what's going on, and then I'm going to move on from there. So pre-market report here, these are stocks that are trading in the pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. Got 31 stocks here on our percentage gainers list, 86 on the decliners. From this perspective, we're looking like a more bearish bias at the open. I'm going to filter down this list because, as you could see, there are small cap stocks in there, ETFs, leverage products, rights, units, closed-end funds, all that stuff that trades on the major U.S. exchanges. We want to narrow down this list to get a little bit more insight. Let's take it down to S&P 500 companies only. And to do that, I'm going to use this filter in ETF. When you click on it, drop it down, you get a list of ETFs to choose from. SPY, that's the S&P 500 ETF. Click on it. The report below gets filtered by stocks that are holdings in SPY. And here we have 3 stocks that made our percentage gainers list, 23 on the decliners. From this perspective, looks like we're setting up for a more bearish bias at the open. Of course, we've had a pretty good run up in January, and I think yesterday started up, sold off a little bit, but pretty good gains still for the month of January. To save time,
we did have one question pop up, D.
Yeah,
it was from 4D, and he said, since it's earnings season, can we do something earnings related, like Microsoft maybe, with a smiley face and a wink? Maybe wants to look at Microsoft earnings.
Yeah, we could do that, but let me then get to the new features first, and then
Perfect.
we'll take a look at that. So obviously we talked about this search console. We just added it. We're still working on those features, and you guys have been sending us some good feedback there. And we're tweaking it, but I'm going to show you guys here this that you may have some of you have actually noticed this. We published this last night in the middle of the night. I'm going to go to the options chain here, and we added this because we noticed a lot of trading is going on in the very short dated options, and to help out those traders and get a lot of people doing it, we're going to create some more tools, analytics, data sets that focus on that trade. Okay, so the first tool I'm going to show you is if you come down here on the options chain, we added this last night, snapshots going back throughout the day. All right, so if you wanted to go back and say that, so this is yesterday's options chain. We're not open yet today, so we're looking at yesterday's snapshots. And we'll see if we add more snapshots. At first we added every 5 minutes. It was too many, but let's just say you wanted to go back and say, well, how did the options chain look at 9:30 in the morning? You click on that, and then you get your prices here. So the stock was 396.32. You can kind of take a look and say, well, here was this was the straddle at 396, $2.40, or I'm sorry, $2.50 here. Or what was the out of the money call, out of the money put, and how did that progress throughout the day? Where was it at 12 p.m.? Right. So the stock did move up. So from 9:30, we could see here, where was I? 396. Was that where I was? I think so, yeah. Went to 566. Would drop the call. So the idea there is that you could go back in time intraday to look at the markets and how they progress. How did they decay? What was the straddle looking like at this point versus this point? To go from half hour to half hour, hour to hour, midday to end of day, 3 o'clock to end of day, and start looking how these options behave. The whole idea is you're doing research and trying to validate certain assumptions. Okay. Of course, you have the whole option chain. This is looking at the day of expiration. So this option had 0 days to expiration. So this only expired yesterday. So you could see how the 0 DT options behaved throughout the day, and you could compare them also with next month, right? How did the straddle in with 1 day to go compared to the one with 0 days to go if you're doing time spreads, and how did that progress? So you get a visual of that options chain going back snapshots in time, right? So we spaced it out here where we think that that these are decent amount spaces that you get a pretty good idea of how the options behave. Of course, if you want to go back into time, and we'll see how popular this feature is and how you guys are using it. But let's say you wanted to take a look at when was the last Fed meeting? Was it December 14th, I think? So let's go back. So let's go back to 2022. I believe, I'm sorry, I got to go back to December. I think it was on the 14th. Okay. I believe that's when it was. So let's take a look. I'm going to load December 14th options chain right now. So it's got to go into our database and go get it. And SPY is kind of a big options chain. So let's see. Okay, there we go. All right. So now we're on December 14th, right? This is defaulted to end of day. So this is at 3:59. And let's see, on the day how it started. So if we go back to 9:30, our initial snapshot, we could see that the stock was 401.92. It's almost 402. You can see here that straddle started out, what's that, I'm just eyeballing 660, 650, something like that, 660 something. So that's where the straddle started out on the day that the Fed made their announcement. When does that come? 2:15, Will?
Yep.
So the day the Fed makes the announcement, started out at $6, let's say 60 cents, right? We could see how the stock progressed. So along with the time snapshots, you get a sense of where what the stock was doing, right? Let's take a look at 2 p.m. So this is right before. So 2 p.m. you could see the stock did rally about $2. So let's see at 2 p.m. That straddle. This is from month straddle at like 405. So right before the announcement, let's say 2 o'clock, the at the money straddle was almost like over $7, right? So it was over $7, right? And there was a new at the money, obviously. We went from 402 to 405. This one was $7. What was this? 402 went up to $7. So you could see that that straddle from the morning appreciated as we go closer to the Fed expiration. So this is the last Fed meeting. Stock rallied about $2 into the Fed meeting around 2 o'clock. And that straddle looks like what it gained about $1, right? What did I say? The 402 was 650.
Yeah.
Oh, it's even more. So this is over $8, right? So this one is over $8, but at the money also over $7. So you could see here that as the day progressed and as we got closer to the Fed meeting, that the options started to increase, option premiums started to increase. All right, so that's jumping from 9:30 to 2 o'clock. That's what I did. Jumped from 9:30 a.m., the very start of day. Then I jumped to 2 o'clock, snapshot. That was the snapshot before. That's the snapshot that we have before the Fed announcement. We do have 5-minute snapshots, but when we tried it, there's so many that it was, you're scrolling forever. So we spaced them out half hour. So let's jump to 3 o'clock. Fed announces what happened. The people start getting the news. There's an initial reaction. What about at 3 o'clock? Let's see how that looks. So 3 o'clock. Here we are. Stock's at $3.99. You can see how much the premiums came in. All of a sudden, the at the money is already $4. Right? Which one was the 405? 650. That came in less than $7. So you could see how in an hour those premiums got crushed. Right? An intraday announcement. Fed announces 2 o'clock. We see how those premiums get crushed post announcement. Okay. Then of course we could go all the way down to the 359 and see how things ended up. And then you can see this is 30 seconds before the markets close. Okay, so we take a snapshot 30 seconds before the market closed because right at 4 o'clock, they tend to widen out. So we want to see realistically where, you could potentially get out of without letting them go fully to expiration, where you could have traded out. And you could do the same thing for the next day, right? So you don't have to do just the front day. You could say, well, what happened in the expiration that I had a day to go? Same thing. Go to 9:30. see where did we open up, right? Jump to 2 o'clock and so forth. So this is one use case, right? Looking back and how things tend to trade throughout the day. You know, if you're looking at options, some people like just to do things maybe right at 3 o'clock or 2 o'clock towards the end of the day. How did those premiums look like? How did they tend to look like? Now we could go back and take a look at those snapshots. All right. So that's a new feature. We'll see how people use it. And of course, look, we brought it out today. We did do our own testing internally for bugs and fixes. If you guys see anything unusual, usually you do email me, but if you do, please email so we can fix those bugs because this is first day out.
Well, you had two people congratulate you on this new feature, D. One actually before the show even started, John mentioned this new feature is a game changer. So John likes
so some people already noticed it. And around earnings, right? A lot of people around earnings like to go there and take a look, and I'll start adding them. We have to capture and save more data, but people also like to go back around earnings and take a look at, well, what happened, prior, before the start of day, end of day. So to some people, it's very important, especially when you're looking at short dated options, or you're looking at specific events and you want to see how the option markets tended to behave around them. Okay. I know you had the 3M.
Actually, it's Microsoft.
Microsoft.
Yeah. That was 4D was asking that.
Okay. I did have some more. We pushed out more new features. I don't know if I want to stay on that, and I had more questions on it. So let me jump to. Let me do the earnings maybe tomorrow because I have a lot of questions queued up. One of the questions was, and I promised this person to cover it, was the skew. And I think that they were looking at this one right here, smile graph. And here, there are different ways to look at skew. There's no one way to measure skew or one right way to measure skew. There's just like different perspectives of looking at option skew. And this is an expiring month. So let's come out to a little bit further. I don't know. Let's go out to January 26th. And on this IV smile graph, the question was, okay, what is this graph telling me? And here you select the expiration month. So I'm on January 26th expiration. And it draws you a visual by strike, the at-the-money volatility. I'm sorry, not the at-the-money volatility, the implied volatility of those strikes. So it takes a weighted average between the call and the put, comes up with an implied volatility for that strike, and then draws a line. Okay. So this blue line here is showing us the implied volatility. Okay. The implied volatility of each strike. So the at the money right here is currently right there, this long line. So it cuts it down. And then you could see from the at the money where the current stock price is, that the implied volatility on each strike is moving lower, right? And as you go higher, the implied volatility on each strike is moving higher. And this is showing us how smooth the implied volatility curve is, how steep or narrow or flat. So you get a visual of the implied volatility differences by strike on a graph, right? So this is the implied volatility on this side, strikes down here, right? And we see that right here, the tail, it kind of comes back up a little bit. What does that red line indicate? Well, the red line is showing us where the same expiration was the previous day. So on the day, right, on the day, we could see what happened to the implied volatility in this expiration, but not just at the money, the entire curve. So we're comparing each strike implied volatility to the previous day, and we have seen how much it changed by. So here it looks to me like the entire implied volatility curve shift almost proportional, right? So it wasn't, it wasn't just like on one side it went up and this side stayed the same. It looks like almost the entire curve shifted proportionally up. Maybe the downside shifted by more than the upside, and I'm just looking at visually, but looking at the space between the downside strikes from the red to blue, looks like that shifted more than here to the upside. I mean, there's probably more demand for puts, and I'm just doing that on a visual basis, because this looks to me like it's pretty, like a pretty proportional shift up. So if you saw just downside moving up, this would look different, right? The blue line up here, the blue line here would be closer to this red line, and the blue here would be further apart. Okay, so think of it as comparing not just how much did the implied volatility in one strike move from one day to the next, but you're seeing the entire curve and how it moved. Does that make sense? So if you want to go back days and say, well, how did it look on the 19th? Click on that. You can see here, this is how it looked on the 19th. So it might have even added strikes. Got to take a look there. But you could see from the 19th on a 2-day, that downside shifted much higher, right? So what happened here is if we compare the implied volatility of each strikes from 2 days ago, then from this graph, the whole implied volatility in general did go up, so it did shift higher, but it looks like it was more dramatic to the downside. All right, and you could keep going back, see how it looked previously. Okay, so that's how you could do it there, and you could do that for any of these expiration months. So you see a lot of volume, or you're looking at a particular one that interests you. Here's one Feb 17th with a lot of volume. That's 787,000. That one you can see looks pretty close. Maybe the downside tails shifted a little bit more than anything here. Maybe this kind of sticks out a little bit, downside tails. Okay, let's see the 19th. So see, it's a little bit more obvious here. What it's telling me is that those downside tails shifted up a little bit, maybe a little bit more demand for those puts. Okay, so that's one of the comparisons. What if we wanted to compare the expirations versus each other? So then we could go over here, and I'm going to take off these. So I'm going to uncheck this and uncheck this. Let's look at two expirations. I'm going to look at this one, January 27th. And let's look at here, February 17th. All right. So what this has shown us is the comparison of different implied volatility by strike with two different expirations. All right. So here January 27th, and maybe January 27th has less strikes. All right, so I guess they have less strikes, or as you go down lower, if the strikes get close to no bid, we remove them. Okay, so the strikes have to have some kind of a bid for us to include it in this. All right, or if it's too wide, we exclude it. And here we could see that the February, going out further, right? You could see is trading at a higher implied volatility across the board than the January 27th. And it looks like the widest spread is actually to the upside, right? So the narrowest is to the downside, the widest is to the upside. So I'm looking at not only, so what are we looking at here? We're looking at the vertical skew and the horizontal skew in one graph, right? We're looking for each skew by strike going up and down for each month. But we're also looking at the skew between one expiration and the next. So you can see that at the monies in January 27th, the implied volatility is 15.1. February 17th, implied volatility 17.6, right? 2.5% differential between these two expirations. But as I go up in strikes, that widen out a little bit, right? Is that correct? Now that I'm looking at it, it's like hold on, did I do this wrong? So that's right, 2.5. What am I here? 2.3. So hover over it and figure out. To me, it looks like maybe it doesn't line. That's how it looked to me, but it's not as narrow as here, right? So between these tails, the downside tails and the upside tails, it did widen out. So here, maybe it didn't. From this spot to this spot, it looks like maybe it stayed the same, but it narrows on the tails to the downside, widens to the tails to the upside. Okay, but you could hover over it and see the actual numbers. All right, so that's a comparison of skew, which is the difference in implied volatility by strike, difference in implied volatility by expiration, and it's a way to plot them and visually see that skew and how it slopes, and how it's different from one option to the next. So hopefully that answers, I got a general question about it, but I did get an image of it, so I wanted to kind of cover it and show these.
It's great that you showed it, because quite a few people in the chat said this is the first time they've seen it.
They've actually, yeah,
something that's helpful for everyone who's on today's show, which is great, D. Awesome job. Microsoft earnings looks like it's after the close today. We'll maybe look at that tomorrow morning if we have time.
Okay.
Awesome job, Dima.
All right, guys. Thanks so much for joining. Stay safe out there. Have a great trading day, and I hope to see you guys tomorrow.
Great. Trade in peace, Chameleons. Have a great day. Thanks, D.